If we're to believe some of the anecdotal evidence that's now coming through internationally, just as the government here in the UK is beginning to look at ways to open up the economy again to try and escape this lockdown that we've been in now for 8 weeks, that there's a chance of a second wave of COVID-19 hitting those economies that have moved a little bit faster than the UK. Let's take a look now at this in the context of the commodities markets in our regular update from John Meyer at SP Angel. John, good to catch up with you again. I know in a little bit of a while we'll be talking about this report from the World Bank on battery metals, but I want to catch up first of all with the risks that are being presented to the markets at the moment, and to you as a commodities analyst, and how we should play these markets on the basis that if we're to believe what we're hearing, there could be a second wave of COVID.
Yeah, well, investors are concerned that we're opening up Western economies just a little too quickly, that the reinfection rate might take off again, and that might mean that economies have to go back into a more severe lockdown again, and that lockdown may in fact last longer. So the risk is seen as rising. Investors are, I presume, would be taking some profits off the table. Hedge funds have been having a very good time in the market recently, particularly following the very substantial fall that we saw when the oil-rich sovereign wealth funds were dumping equities a few weeks ago. And so what we're seeing now is, well, we've seen a good recovery from that, but we're seeing concerns over inflation, over bankruptcies, over bad debt levels, all coming through, and that has lifted gold prices to higher levels. So we're about $1,705 an ounce at the moment, and the margins are great for these gold producers. That's combined with much weaker local currencies, the South African rand, the Egyptian currency, for example. Many currencies are very much weaker, and the oil price, which is a big consumable for mining companies, has also collapsed.
That's an interesting point, actually, about the currency markets, because when you get a weaker currency, it means that, in fact, gold is worth an awful lot more. And I believe that gold is at record highs in some of these economies where we've got these beaten up currencies. I know here in the UK, if you're buying gold in sterling, it's sort of it's quite expensive at the moment. We've just shown a chart of the gold price. Are you suggesting here that there's an opportunity to get into gold itself? Are you talking bullion, or are you preferring to look at other areas such as coins? Of course, is another possibility, and owning the bare metal, and that, of course, doesn't have the disadvantage of any capital gains tax if you're holding sovereigns in this economy. But what about the chances of equities and ETFs? Of course, you've got to consider as well. Where is it that investors are best placed to look for the best returns if you assume a better price for gold as you look out from this point?
But it is quite possible that gold prices will look to test $2,000 an ounce in this kind of environment. And whilst we're not overly bullish on that score, and I think it's fair for investors to buy gold ETFs. We don't think gold is going to see the ETF problem that we saw with West Texas crude, for example, that was seen a little while ago, where investors were unable to roll over the West Texas contract. But I think gold ETFs are much more solid. But to be honest, the much greater uplift is likely to be seen with the underlying gold equities, which haven't really risen very much because equity markets have been depressed in recent months. Gold stocks have outperformed a bit, but nothing like by as much as their margins are going to improve. So when you consider the combination of lower oil prices, weaker local currencies, and a much higher gold price, then margins are going to increase by many times for particularly for the higher cost gold producers. And if you consider that in recent years, gold mining companies have been under a lot of pressure to cut their costs, then actually they're in very good shape to benefit from the very substantial margin improvement that we're seeing. And on top of that, we're also seeing new M&A activity coming into the market where there are definitely buyers for some of these gold mining companies.
Yeah, I won't go into gold companies themselves at the moment. I think if we can, move on to this other area that I want to talk about, and that is this report from the World Bank report on minerals for climate action. We've spoken about battery metals before, and of course, this is all part of this idea about moving into more environmentally friendly ways of dealing with, of course, transportation, so far as battery metals are concerned. But I know that this World Bank report opens out all sorts of other possibilities in terms of renewables for energy. And of course, this is an area that I know that you are also closely, intimately associated with because of the metals associated with this sort of move into the new environmental ways of finding ways to heat and generate power within the economy. What are your thoughts on this report, and what are the sort of metals we should be looking at?
Well, this is a very interestingly timed report from the World Bank, and what they're looking at the longer term picture for metals that are required for electric vehicles and for renewable power generation. So we're talking about wind farms, solar farms, and they also focus a lot on batteries, on batteries for grid support, so that as the world puts more and more wind and solar capacity into its power generating system, that actually it can better balance that power generation through the combination of lithium and vanadium redox batteries, for example. And so pulling all this together, it becomes obvious that an awful lot of new metal supply is going to be required, particularly some very specialized metal supply to meet the demand for the construction for all this new infrastructure and the electric vehicles that are actually selling remarkably well.
My understanding is from reading briefly the headline on this report is that there is a massive supply shortfall that's expected in the years ahead. Where should we see potentially most uplift, the areas of minerals we should watch most closely to get the best returns?
Well, I think investors should be looking at rare earths. They should be looking at a whole series of businesses that supply these specialist commodities. Vanadium, Bushveld Minerals, for example, the rare earth guys like Macango Resources. There's a bunch of companies out there that I think are critical in the supply chain, are really important because not only is China has been dominant in the rare earth supply chain and production in recent years, and still does most of the processing. But Chinese supplies of their China of rare earth containing clays are starting to dwindle, and the world also recognizes that it needs to have uh, diversification of rare earth supply. So there are a number of other Western listed rare earth companies that have been developing resources, and Macango is clearly a fairly key UK listed company in that, and there's Pensana Minerals as well. So there's a number of these businesses I think that are going to become increasingly important. We know that one of the Australian companies is looking at developing a rare earth refinery on Teesside in the UK, and we support that idea. We think that's a very good idea. It's close to some of the raw materials that are required for the processing, and it would certainly help the Teesside area. So there's a lot going on here, and let's not forget other metals as well that will be required in electric vehicles. So we're talking about tin and copper and nickel, because there's a lot of nickel in the batteries. And we were talking to Tauga Resources on Monday about the orders that they're seeing for their new graphite anodes, which are going to go into new batteries. And they are seeing demand for more material than they can actually supply at the moment. And so that's very important. They're in touch with all the companies that are building battery manufacturing facilities in Europe. And the European Union is also going to require more local content, battery content for European sold electric vehicles. Now, again, that's a very important part of the supply chain to consider.
I'm stunned actually by some of this report from the World Bank. Just to quote one figure here, and in fact, you cover this in I think your release. It was in fact this morning. Production of cobalt may need to increase by a whopping 460%. 460%. In the longer term, are we able to find the resource to satisfy the demand that appears to be growing for some of these areas of these metals, where previously there hadn't been, well, to my limited knowledge of understanding in science, that cobalt has never been something that's really been sought after in large amounts before. This certainly seems to be something where increasingly it's becoming important. Are we at a danger point with some of these metals where we're just not going to be able to find sufficient amount of supply?
Well, cobalt's a pretty boom bust metal, to be honest, and we've seen the price go up and down over the years. And the problem is, so much cobalt is actually mined in the Congo, and there have been periods of time in the past when they've been flying cobalt concentrates out in small planes to get it into Western converters and manufacturers. And so it's a tricky industry, that one. Cobalt, of course, has been used in batteries for a long, long time, but lithium batteries have been using cobalt as a kind of stabilizer. The next range of lithium batteries will use a lower content of cobalt, but of course, there will be many more batteries made as the number of electric vehicles in production increases. So it's still an important metal, but I think for me, cobalt is something that will become less and less interesting as battery manufacturers move on to technologies that use less cobalt, and they move into things that are where the supply chains are more secure. So for me, it's the specialist graphite and lithium producers and rare earth guys that are more interesting.
Yep. Okay. Look, John, we'll leave it there. But thanks indeed for joining us. So certainly an interesting read, I think, if you can pick this up from the World Bank website, Minerals for Climate Action, worth a cursory read if for nothing else. John, thanks for joining us. John Meyer there from SP Angel with our regular look at what's happening in the commodity markets. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.